All right, welcome back to Wook Capital Management's 29th edition of our Wook in Review broadcast. This is Managing Director Rod Alsman, and I'm joined by our social media manager, Joe Ponatello. Just want to make sure that everyone knows that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay, mouthful out of the way. It was pretty choppy-ish week with some mixed data economically. We have kind of Tesla, China, freight, and rents as kind of discussion topics that we can talk through once we get kind of through those topics, and we can really take the conversation wherever anybody wants to. Again, just to kind of recap, I'm presenting my screen in the Wook Discord server. If you type wook.gg into your browser, you can access that. And I obviously audio will kind of be voicing over things. So Joe pinned the thread to the spaces, and yeah. So let me adjust my screen here. Let's talk Tesla to start off. But I guess before that, just programming note, we have our Wook Book Club on Tuesday night at 8 o'clock. We're going to be discussing Michael Lewis's The Big Short. As we've talked about, we thought it was a fitting time to talk through The Big Short on the back of the bank hiccup crisis, whatever you want to call it, from March. So we'll be doing that Tuesday night, 8 p.m. Eastern time. If you want to join live and be part of the conversation, the recording, as with all of our content recordings, will be available on our YouTube channel, Wook Capital. So yeah, we had Tesla earnings that came out this week, and it shouldn't, I guess, have been a surprise. The company had cut prices a half dozen times year to date and saw a huge decline in its margins. So the price, from a price perspective, shares of Tesla are down 11% over the last week. The closing price looks like 165, give or take. So Tesla's enterprise value is still over $500 billion, though. It's still valued highly uniquely in context of other companies who receive the vast majority of their profits from selling automobiles. The company definitely, Elon Musk likes to say a lot of things that may or may not be true. If you want to believe Elon Musk, it's really right around the corner this time when it comes to autonomous driving, and that's the reason why it doesn't matter what they sell their cars for, because when autonomous driving happens, like he's been promising for most of the last decade, any day now, that Tesla will have unique competitive advantages and be able to draw in incremental high margin revenues from a autonomous vehicle fleet. I don't believe that. I think it's puffery, like most things out of his mouth. But that is seemingly the argument that he and the company are making, that they can afford to continue cutting their margins. And the reality is they're the low-cost producer when it comes to electric vehicle makers who are not Chinese. So they have margin to play with. They obviously played with a lot of it this quarter. But I think the broader reality is that big ticket items, consumer demand for those sorts of items, especially with interest rates having risen so far, clearly he's seeing demand challenges as much as he likes to pretend they don't have those challenges. So, it was a rough quarter, I think, for them. Second quarter, they've already done they did price cuts right the night before earnings, we're already halfway through the second quarter. So it'll be very interesting to see how low do they go. We got clarity from a federal from the IRS on like which vehicles are eligible for the tax credits. So that's going to continue to be something that helps them a bit in that some of their vehicles are eligible because of the minimum content requirements for manufacturing battery content or the vehicle assembly needing to be in a US or a free trade country. So Tesla does have that help. But again, the quote from Elon is that we've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin. Again, the company's made massive factory investments, so it does make sense that they don't want those assets to be idle. They want to continue to produce vehicles and spread that fixed cost investment across more vehicles, but it looks like they'll continue to cut and take margins down. So everyone's favorite stock, I think, to kind of observe with like an eye, like what continues to be interesting. Happily welcome anyone's thoughts on Tesla. If anyone wants to chime in on what they think about the notion that this is a strategically, that this is Elon Musk playing 6D chess, and that this is going to enable Tesla to retain the meaningful share of electric vehicles in the U.S. that it has, or just any thoughts on Tesla. I'll pause if anyone wants to chime in on Tesla before I move along, or we can circle back to it. Chris, I know you have thoughts on Tesla, I'm sure, or what's up, man? You're on mute.
Oh, hey guys.
Hey,
Chris.
How's it going? Yeah, so Tesla. I think more and more people are starting to realize that Elon Musk is a great promoter. He's done a really good job in terms of communicating his vision, right, and what he believes, and getting people excited about electric vehicles, which I think it's a big part of the equation. You can't really discount that, but on the other hand, he hasn't really delivered on a lot of his promises, which it seems like investors are up to this point have been okay with that. This guy's a visionary, but they've really stagnated in the last year or so. And they haven't come out with new models. There's the Cybertruck that's supposed to come. I don't know if they'll be able to release that in any meaningful quantities or at the prices that people had been expecting them to sell at. So and the design, of course, is kind of weird, but other than that, there's no real new car products. Whereas if you look at these many other EV manufacturers, they're coming out with the full product line of cars, particularly in China. You have the Shanghai Auto Show going on right now. So I think that's a very big weakness for Tesla. They don't have any new cars really for people to get excited about. Like the Cybertruck was announced in like 2019. How long ago was that announced?
I lost track, man. I hate it.
Who remembers the Roadster?
I mean, let's be honest. Elon is the most successful promoter of all time. Elon Musk, without a doubt, is the most successful promoter of all time. It's hard to
and the
argue
stock
that
has
point.
earned a premium because of it. I mean, having the word of mouth and advertising, and the big, cult status that it's had. I think you could argue also a stock like GME has kind of had that, with the in a smaller scale, with like Ryan Cohen or whatever, and that kind of plays into the valuation of a company at some point, right? You have a very big promoter, and a lot of people are drawn to a brand. But in terms of selling cars, I think they're in a lot of trouble, and this move to cut prices, it seems like it wasn't really planned. It just has to do with the economy, and Elon has admitted this. He said rates are up, and I need cash to pay off my loan. So
yeah, he makes weird comments about demand. Like he'll say that there's insatiable demand. Well, if there's insatiable demand, then you wouldn't be cutting prices. So I don't know if whether he's purposefully obfuscating reality or he just doesn't. who knows what the reality is, but clearly they are not selling, the vehicles necessary at the prices necessary with the expectations embedded in the price, right? You still got, from a sell side consensus perspective, 23% sales growth in 23, 30% in 24, 25% in 25. That's way off of the 50% that the company, that the cheerleader in chief keeps touting. So they're going to either miss sales or they're going to miss profit, right? Like you can't square the two. So it's just going to be interesting to see how it keeps playing out. You've made the comment, Chris, that from a portfolio allocation perspective, the average retail investor has an outsized allocation to Tesla. And I think that's right. And, we've talked in this series previously about the reporting from VandaTrack and others about the massive inflow year to date, right? Shares closed 22 around $100, and it went up 100% or many hundreds of billions of dollars in the back of retail inflows that were multiples of the next 5 to 10 stocks combined, right? So it's not a sustainable thing, right? Like it's been in this bubble, in my view, for most of the last few years, and bubbles always have some reality that supports them. It does feel like we're seeing that continued deflation of this bubble. I would not be surprised to see Tesla trading in the double digits before the end of this year. And look, it's not to say that the company doesn't have some advantages, right? They're, again, from a fully loaded pack cost perspective and a vehicle manufacturing perspective, they're clearly superior to their legacy OE competitors and other incumbent competitors outside of China. I'll be just very interested to see kind of how that ongoing competition with the Chinese, because I know you follow the Chinese auto market a little bit closer, and it seems like the allure of a Tesla in China maybe isn't what they would have hoped that it would be. Like Chinese consumers aren't, I don't know. Any take
there? I saw a tweet from a few days ago from a Chinese pundit, and he was saying that, Chinese no longer see Tesla as a luxury car anymore. They don't see it as an expensive, desirable luxury car, like as a status symbol. Whereas I think early on in the pandemic, when the cars started flying off the lines over there, people were swarming to get these. People liked Elon back then. Maybe they still do, but it's the times have kind of changed and they've cut their price a lot. And when you own a car and the price drops a few months later, I think even in 20. Last year when they were doing the price cuts in China, a lot of people got really angry because they would cut the price by a few thousand RMB and a couple $1,000s, and they had just bought the car a few days ago. So that's a big problem, that they're kind of sacrificing demand in that way, by they're making it less desirable to own and hold the car. Because
and they were free cash flow negative if you back out the regulatory credits this quarter. So regulatory credits are real, and you include those, but it's a worrying sign in the context of how much capex they say they have planned. And look, I'm not gonna go down the path of that. There's a lot of accounting fraud. Obviously, a lot of people some people have the view that there's accounting fraud going on there. But you can't fake the clear impacts that they're seeing from the prices being beyond the reach of the incremental buyers at this point, right? They've got the early adopters, they've got the brand loyalists, and as you start to sell to people beyond maybe that mix of the populace, it's clear that price becomes a bigger consideration. But it's also fair to point out that net of the tax credit, you're getting pretty close to purchase price parity, which for the consumer side of things, that's a bigger, from all of my reading over the years from the various kind of consultancies on adoption curves, like that's the big thing for consumer is upfront price parity, because most consumers aren't, doing in their head the math around the total cost of ownership savings from lower fuel, lower maintenance, et cetera. Like fleets, of course, as we've talked about at length, care much more about a total cost of ownership. Consumer cares more about, is my payment the same for the Tesla as it would be for the whatever insert ICE vehicle here? And if so, then that's a big that's believed to be like a big hurdle for adoption. So we're getting there, enabled by the Inflation Reduction Act credits, at least on the U.S. side. So I know that those estimates have all been like pushed up markedly since the passage of IRA. So, but in that vein, I guess not specific to Tesla, in the vein of the IRA, another story that I saw today. That's not today. It was it was today. Sorry. So it was Volkswagen, right? Obviously, Volkswagen, the largest car maker in Europe, investing more than $5 billion in this battery cell factory in Canada. And again, it goes specifically to that point of that these incentives are what make the market for this. So they didn't go to the US. They were initially going to go to Europe, but after the IRA, they thought to come to the US, and then Canada decided to match the US's incentives. So it's this ongoing, real significant reorientation of supply chains post that. Just like it's really hard to understate how impactful the Inflation Reduction Act is, because so many of these things are uncapped. The amount of money that can get spent by the federal government is uncapped by so many aspects of this bill. So we'll see, right? From a political uncertainty perspective, does it get walked back if in 24 Republicans take control? Who knows what that looks like? Recall that Manchin has been upset about the way in which he went along and was kind of the deal maker, and his expectations had been that they would do a better job of really, I guess, having this protectionist policy. But since it spreads across to kind of all countries as part of free trade, right? So if you're manufacturing the battery materials and cells in South Korea or in another country that has a free trade agreement with the United States, that qualifies. Whereas Manchin, of course, his hope had been that we'd actually see more stateside investment. So this VW $5 billion plant going to Canada because the Canadians are matching the US's incentives just kind of shows you it's all a race to the bottom. It goes back to like Amazon with HQ2. Remember, everyone was bidding like crazy for HQ2. They were showering Amazon with incentives, and really you won if you didn't win, because now, right, they're walking back HQ2. So, not to compare a battery manufacturing plant to that, but it just seems like this continues to be the story for a lot of manufacturing trends, is whoever throws more money at me wins.
Yeah, I was going to ask you, if you were in Elon's shoes, let's say, if you were managing Tesla, like what would you do at this point?
I hope to never be in his shoes, but if I were the operating decision maker at Tesla, I certainly wouldn't want to have such haphazard, to the point you made. If I'm a consumer and I don't know, if I expect that the price is probably going to continue to drop, why wouldn't I just wait? So I would want there to be more clarity in the messaging, as opposed to it being, literally every other week a price cut. I think it would be better to just be upfront and kind of, listen, we're going to do whatever, we're going to lower the price to X, and it's going to stay there for at least Y. And I get that maybe that commitment isn't ideal, but I tend to think that without there being any commitment, that the marginal consumer is much more apt to just wait. Why would I buy the vehicle knowing that there's a high likelihood that I could get it for thousands of dollars less by just waiting a few more weeks? So I think that's an issue that they have right now. So I would try to address that by not being so all over the place with pricing. I also, we'll get sidetracked if I say the stuff that he needs to not be doing.
Yeah, I was saying earlier on Twitter, I was saying that he should do a cap raise, maybe 10 to 15 billion,
Oh, absolutely. They should have done that last year.
They were doing it a lot during COVID, 2020, 2021, but they kind of stopped. And I don't see why not. I mean, if the executives want to sell, why not raise like 10 billion and build some new factories with new models? I mean, they need the cash to do that. So, it seems with these models that are becoming kind of stale, maybe that's a direction they should go in. But yeah, I don't own. I'm actually short Tesla right now, but like.
One other random data point, that VW manufacturing facility, according to Trudeau, will be the largest manufacturing plant in all of Canada. So, again, these are some serious investments going in. Tesla's obviously made serious investment in its own plants. So, I think that the other argument is that they overexpanded, it seems to me. And now they have to fill that fixed cost by taking price. They don't really have another option. So to your point about could they have and should they have raised capital to help fund some of that, now what happens if they find themselves needing to continue taking price down? I think the fortuitous thing for them is that the shareholder fan club is unlikely to leave them overnight, so they can probably continue to tap capital markets at attractive prices, right? Like a $500 billion valuation today, still they could, dilute 1%, raise $5 billion, right? It's a lot of advantages that they have because of the cult that supports them.
I think I was speaking more in the vein of just reaching new product segments. Like you remember you mentioned vans earlier. Like why didn't they get into vans?
Yeah.
Like a hot hatch or a small, car. I mean, it's kind of a little bit off-brand, but if they can make something that looks nice.
Well, yeah, it goes back to I think we talked about it last week or the week before, that if they were truly intentioned around creating products as opposed to hype, they wouldn't have gone with the Semi. They would have gone with a step van product, or a small class 2, 3 van. It could have been class 4, 5, whatever, that could be used by all of the final mile fleets. And from a cost perspective, from a battery perspective, they would be able to put packs that are actually comparable, if not smaller, than the packs they put in their consumer products, because those vehicles, that segment, is actually very low mileage. We're talking, a UPS brown step van does 60, 80 miles a day and returns to base and plugs in, and you could fuel that with a level 2 charger. You don't need a DC fast charging system to kind of take care of a fleet like that, and managed software can enable you to not need the same depth of upgrades. UPS has been on this for many years, but they didn't, and that vacancy was filled by Rivian, who has a product in the market and that Amazon's using. So it never made sense to me why they went with the Semi announcement in 2017 as opposed to a functional product that they could be selling in the market today. Instead, now you've got General Motors Bright Drop, Rivian's product, a lot of others, including Ford, that are now kind of filling that electrified or electric van space, and Tesla doesn't have a product in that niche. And Tesla could have actually carved out, I think, a meaningful share in that niche, and it would have been a way for them to get on board with commercial fleets that then eventually perhaps the Semi would have made more sense. So it doesn't seem like it was actually a very serious strategy for them to pursue the Semi. Again, I worked at Ryder from 2017 to the end of 21, and Ryder had an order that they disclosed for semis, but they still have yet to get them 5, 6 years later. And I would tell you that, again, the sentiment that I got at Ryder was, after kind of having discussions with all of the incumbent and the startup OEs, that fleets are conservative, commercial fleets are conservative by nature. They're much more apt to buy from a trusted supplier. It's going to be hard for the startups to really break in. Your Freightliners, or all the other, legacy players. I think on the commercial vehicle side, actually, it's going to be harder for them to be disrupted. So, you see these Semi videos with a lot of breakdowns hauling Frito-Lay product. Again, that was all made possible by significant grant money from CARB. It's not an economic business case. that a fleet is going to go out and buy these electric vehicles. And again, though, Inflation Reduction Act, meaningful accelerant, up to $40,000 per vehicle credit for the commercial vehicle side. So that does defray a meaningful portion of the cost premium that a fleet has to incur to purchase an electric truck versus an ICE truck. But yeah, I mean, I think Tesla actually went about it all wrong. If they were serious about things, I just don't think Elon is actually that serious about like the semi. I think
I don't think he really
it was
cares
all
about
just
the duty
marketing.
cycle of commercial trucks. He's not really. That's kind of boring for him.
Like I sat in the semi in 2019, the prototype, and you get a lot of feedback from actual truckers. It's like, why would you put the seat in the center of the cab? Now I can't reach out the window and hand my paperwork to like just stuff that again like they did these things that it's like, okay, cool, it looks neat, great, but did you actually engage with your buyer? I don't know that they did on the for the semi as much as maybe they should have, and who knows? They say they're building a manufacturing facility to start scaling that. To your point, they on the Cybertruck, they say they're going to be producing it by year end. I don't know that the actual sales of Cybertruck will be as impressive as maybe the orders would imply, because I think a lot of people like to place the order. It's pretty easy to place the order and say, oh, that's neat. I'm interested in that. It's a lot different when you actually have to consummate the deal and the price. What did he promise at first? 40,000. It's not going to be $40,000. So let's see how that pans out. But yeah, we're talking about Tesla since they had earnings this week. If anybody wants to chime in, please don't hesitate to do so. Whether you're bull, bear, or neutral, or we'd love to hear any insights you may have. Otherwise, I will continue on. And I've got freight recession as a topic to get to as well, since we had JB Hunt report earlier this week. So not seeing anyone. Oh, Steve.
Hello.
What's up, man?
Hey, what's going on? Yeah, I just want to talk about Tesla just really quickly.
Yeah.
So just a couple of things. First of all, just want to talk about the I mean the results obviously is kind of mixed if you're looking at their earnings. I mean the bottom line was really kind of contributed in a good bottom line because lower tax rate and high expected interest income. But the margin compression is going forward is gonna that's the ongoing concern. But I think what's interesting is obviously what Musk said in call, he said this a couple of times. I mean, I can quote him. Let's see. Well, he said something about like we are be able to sell we can be able to sell the car at cost or even a loss, but still generating significant net present value. I mean, obviously,
it's incredible he's allowed to say these things. It's just so it just sucks the SEC never actually stood up to him, because he can continue to get away with these outlandish statements. I get it, right? Like theoretically, what he's saying, you could make the argument, sure, if I sell you this razor blade at no profit margin to myself, and if there is in fact high margin software revenues to come in the future, sure, right? That could be factually accurate. But when you have someone who promised in 2016 you'd have the car driving across the country with nobody in it, next year, right? We're literally coming up on a decade that the guy's been making these promises and unfulfilling these promises. And I just, it irritates me that he continues to be allowed to get away with it when I just do not see a scenario in which the hardware they have installed on these vehicles would ever satisfy a level 4 system. It's a fantastic level 2 plus autonomous advanced driver assist system. That's the problem, though, is that what he shills is not the product that he has. The product that he has is actually quite good if used with your hands on the wheel, with your eyes on the road, as it needs to be. And unfortunately, right, this whole full self-driving, his ability to charge people, which look, kudos to him that he's been able to generate meaningful revenues selling some people vaporware for a long time now. But until the product is actually in use, right? I think it's just pretty insane for him to continue making these claims. But he will, and he won't see any repercussions from it. And my sense is that until they actually got serious and were using LiDAR, right? They have just cameras, right? It's a very, I mean, there's very strong opinions, I guess, depending on who you talk to in the technical space. Some people think it's a complete charade that they would ever think they could get to level 4. I know they tout their, whatever buzzwords you want, neural net, AI. But I tend to think it's all bogus.
Yeah. Well, he didn't. Well, he said a couple times, and then like what we say, obviously, it depends on if he can really generating that future cash flow that whatever he's expecting. And then now we're gonna lead to the ARC model. But I just want to also comment on what he said about his energy business. So he's expecting to use to approximate auto gross margin, and then the company was like trying to do the burning Austin plans. Will have a margin headwind until the volume is reached. So they're suggesting that growing volume is like a priority over the price in the near-term profits. I mean, which it's kind of everybody expecting. But another thing is, so we're going forward. If we're looking at everybody's focusing on is really the gross profit margin. That's fell expectation and with price cutting stuff. But I mean, it's gonna be kind of naive if you assume this is gonna be temporary, given if we indeed, I mean, we just had a decade, more than a decade of easy monetary policy environment, and then which I'm gonna go into the economy 101 how a rising interest rate environment is gonna compress on employment and these two corporate profit margins as such. So you have kind of remodel whatever your revenue, margin growth rate 1 year out, 2 year out, maybe 3-5 year out, it's eventually going to impact your bottom line. If people are going to shift and focus on current quarters, and everything's going to be fine in 5 years. I mean, you can say that in any other companies, but once actually when the number shows up, I think that people are going to start panic. Okay, I mean
they've already started panicking. Yeah.
Well,
I mean,
yeah.
The point that Tesla had made was that they could continue to grow the top line at 50% for how many years, right? And now no one believes that they'll be able to get close to that number. At least the consensus on the sell side is severely lagging that. I had mentioned the numbers explicitly earlier. I'm not sure if you joined after the start, but that right, you've got the deceleration and the top line growth, so that's already part of the story breaking, and now you're going to see a margin profile that's going to look more comparable to Mercedes-Benz, a legacy internal combustion engine premium automobile maker who has low teens operating margins. So I don't know. I've never been a believer in this, like the story that the Tesla narrative is. It seems like some of those narratives are seriously coming into question now. And, the stock is still, again, valued at more than $500 billion. So, it's down 10% on the week, but it could go down 50% and still not be inexpensive.
Exactly. It's like what you said, narrative. People focus on narrative moment. Narrative driven by short-term price assumption. But like Ben Graham said, right? Like in the long term, when people look at long term, that's where fundamental coming. We're looking at data, and then people are gonna start looking at, what's the discount rate? What's the WACC you're using? What are we talking about here? It's not just about we're just talking about like stories. But now I just want to I don't know if anybody had a chance to look at the ARC, the updated model by Cassie Wood. They just updated, I think, this week.
Yeah, I heard that. I don't waste my time looking at it anymore because it's not worth my time, in my opinion. But I would be happy to hear if you had a summary of it.
So they put a lot of assumption in it, but I haven't had a chance to have a deep dive. But just a couple things I was I was just going through. They were talking about. So one of the things they're talking about capital allocation efficiency. So they're saying the capital capex per incremental unit will be improved. Well, has improved, which is true. Well, so they're saying so they shows that capital is not bottleneck for growth limitations, and then Tesla should be able to grow quickly as the management deal with the supply chain constraint as a lot. I mean, those are very like backdated argument, but I think what they're really looking at is, they're looking at the energy storage business. So they're estimating energy storage unit will contribute about like 6.6 billion.
Well, here's the issue. So I pulled it up,
Right.
and for anyone who's following again online, or you can see my screen if you're following in Discord, but you've got robotaxi comprising a massive component of the expected value. So the fact that they don't even they have robotaxi in every scenario, right? That's just intellectually dishonest to not have your bear case exclude this product that's been promised for more than half a decade that has yet to come close to commercialization. I just don't think that they're intellectually honest with their analysis when I see that sort of thing going on.
Yeah, absolutely. It's the bear case is what, like 1400. I think that's the bear case.
Yeah, the bear. So I'm looking at it now. 2027 price estimates from ARK are 2,000 is their base case dollars per share, 1,400 in their bear case, 2,500 in their bull case. Again, as I said, I didn't look into this. I'm looking at just kind of the page from their website now, and I know that I saw, for example, Cubico, our beloved crusher of hopes and dreams of some, who I think pointed out that the insurance model itself made no sense. There was like no operating costs baked into the insurance model. So yeah, I don't know that. I haven't looked at that myself, but I know that a lot of the skeptics are of the view that this is kind of just a bullshit report. That it's like, yeah, if you want to make these assumptions, sure, then the price is going to look like that. But it seems like a lot of these fundamental assumptions are flawed to me. In the lithium space, though, right? So there's a couple things to talk about, though. You've seen lithium raw input prices kind of plummeting recently after a huge run up, and there was big news in the lithium miner space. So you've got Albemarle and what is it? SLQ is it the Chilean miner. So both of those companies were down huge today on news that the government kind of given them a really bad, I guess, set of choices. Let me see if I can get the story and hammer that off. But look, Tesla has the best cost point. We all agree that they are a cost leader when it comes to their all-in loaded pack costs versus their other startup competitors and their legacy competitors. So how that advantage is real. The electric motors they have are near best in class. So there's some real stuff, but it just gets back to it's so disconnected from reality. It's hard to have a reasonable discussion when you've got people putting out reports that say that you're going to have trillions of dollars of value coming from a robo-taxi fleet in a few years.
Yeah, I know what you're saying, but well, anyway, I was just open to, if anybody had a deeper dive in the model, open to hear if any bull out there and just listen to their thesis. I know these guys who published the report, like the analyst, what's her name, Trista. Actually, I talked to her before. She is actually very passionate about what she does. And whatever you gotta call them a fraud or anything. These guys really believe what they do. So, I mean, give
Most
them
cult
credit
members do.
for to stick there. It's type of behavior. But anyway, I just it's interesting. I don't know if you guys want to talk about the model. I was gonna use the this as a benchmark to look at the was the professor's model I was talking about last time, just to see the delta in between, but I just haven't had a chance to look in too deep yet.
There's some stuff that I look at this model that just doesn't make any sense to me, like on its face. How would the average selling price in a bull case scenario be $8,000 less than a bear case scenario? So you have a 26,000 ASP in their bull case by 2027, a 34,000 ASP. I don't know. Just before I go too far away from it, I got SQ. I don't know why I'm thinking SQL. It's SQM is the Chilean miner, and Albemarle, who both got absolutely tanked today. Albemarle was down 10%. SQM stock was down 18%. So we're talking many billions of dollars of market cap wiped out for both of these lithium producers. These are the two big Chilean lithium miners. So the issue is that in Chile, the quote from Reuters is that young progressive president Gabriel Boric said late on Thursday in his announcement that the company would not cancel existing contracts, though it would try to negotiate with mining firms to voluntarily shift to a public-private model. So SQM has a contract in Chile that expires at the end of the decade. Albemarle's got 20 years on its contract, but it's almost like a give us a majority stake in your equity, or we're going to rescind your ability to mine here. It's kind of like a gun to the head moment for them. So, given that Chile is about a third of global lithium production currently, I thought that was actually a big deal. It's related, right? You would think all else equal, if companies are dissuaded from investing in mining due to concerns of governments taking their assets and the like, whether it's Latin America or elsewhere, that they'll invest less, and that prices would otherwise will thus be higher. So I mean, that was a big move in both of those lithium stocks today. I had not read the full story until just now, but
yeah.
Look, I guess to go back to the model, you're talking about them estimating in their bear case that the company's generating $200 billion in revenue from autonomous ride hail. I mean, what does Uber generate in ride hail revenue this year? I'm just trying to think of the delta between reality that they're like coming up with there.
It's interesting. I'm just reading the disclaimer, like under a very small font, like in the note. It says Tesla human-driven ride hail and auto business line, which carry higher EBIT margins, make up 50% of EBITDA in our bear case. In the bear case, Tesla doesn't scale as aggressively and can remain at a higher price point for longer, which benefit margin structure. I was like, okay.
I'd like to see their analysis on Cruise and how much value Cruise will contribute to General Motors, because if their view is very bullish on autonomous driving, then it seems like the upside for General Motors would be multiples of that of Tesla, given they actually have a product on the streets today operating in this capacity, but that's probably not going to sell them as many. Well, I guess they're not selling subscriptions, they're selling assets under management, but I digress. Like their worst case electric vehicle gross margins are higher than what Tesla's gross margins are presently. So again, it's kind of just doesn't seem like it's that, I don't know. I get it, right? They say they're very thoughtful and rigorous with their analysis. It just doesn't pass my smell test, though.
Yeah. So anyway, any bulls out there? I'd love to hear their thesis. If not, then
the bulls are probably not tuning in because they probably know how I feel about it. But I'd be happy to hear it. Look,
yeah, it's an open source model, so
you're welcome to chime in, though. So their Monte Carlo model launch date for robo-taxi commercialization is using late 2024 as the weighted average of all cases. I'm going to take the over on that. But again, if anybody else wants to come up and talk Tesla, we can. I know it's endless. We can waste endless breath on Tesla. While we wait and see if anyone else does want to, I'm going to kind of riff a little bit on the freight recession discussion. So, JB Hunt, I think they're always kind of the reporting bellwether. They report first out of all the transportation companies. For those who don't know who JB Hunt is, they have a very large brokerage division. So they are brokering, connecting shippers and carriers to haul freight, whether it's over the road on a truck, whether it's intermodal. They have a standalone intermodal division where they manage the drayage, where you bring say you have a truck that goes to the port in LA Long Beach that hauls the freight to a rail node, and then the box is loaded onto rail cars, and it goes on a train and gets carried to an end point, whether it's Texas, in Atlanta, whatever. And then another truck is going to take that box and haul it to the final point. So JB Hunt's intermodal would kind of cover both the truck haul. They have the agreements with the rail carriers that they put their boxes on, and then they'd handle the end haul portion. And then they also have dedicated contract carriage. So that's a situation where JB Hunt signs a deal with a Target, a Walmart, whoever, to haul a certain amount of freight in certain lanes, and they're under a contractual agreement to haul that freight in those lanes. So it's stickier than, say, the spot market. You're going to agree on a price for the freight in those lanes. You're going to negotiate that every year, or you might have a multi-year agreement for a DCC contract. But they're seeing the what I've kind of said for a while is that the freight market is in a recession. It's not the end of the world, but the freight market has been in a recession. They called it a freight recession on Monday, so now people will throw the word out more. But really significant deterioration in spot freight markets. So it's not just the cost of all of the boxes coming over from Asia, in terms of those costs coming way down. It's also what the truckers are getting paid per mile over the road. And I looked at what FreightWave's boss, Craig Fuller, was kind of saying for their outlook. My computer's just being a little bit laggy, so I can get that one up. But it's tough because what you hear from Hunt too is that even their shippers don't really know what to expect for the back half of the year. So you've got a lot of uncertainty around what the outlook for freight is going to be into kind of 3Q and 4Q. So you've got kind of cooling demand. Tesla is a good proxy, I think, to see some of that cooling demand. You've got line haul freight rates that are just, we're at that point in the freight cycle where you've got truckers kind of taking loads where they're basically losing money, but anything to keep the wheels turning. So spot rates are about $1.56 per mile. And quote from Craig Fuller at FreightWaves, if you go back to 2019, it was a bloodbath. It was the last Great Recession. We were reporting on multiple bankruptcies a week. Some of them were quite sizable. And basically, we're back toward that kind of a market. Because he says, we're at $1.56 a mile today, which is 9 cents higher than the 2019 point that he just compared to the Great Recession. But your operating costs have gone up markedly in 2019. The equipment costs have gone up, the labor costs, the fuel costs, the insurance costs. So he notes that those non-fuel cost increases are up at least 30 cents a mile more, not including driver wages. So it's actually, on a like-for-like basis, pretty much as bad as or worse than 2019, which was like the Great Recession. It is a bad time if you're not hauling contractual freight. So that's why a big player like Hunt, who has a lot of long-term contracts, is, it's painful, sure, but they have the balance sheet and they have the wherewithal to absorb that. But if you're like most of the haulers in the freight market, a very small mom and pop owner operator, then depending on your situation, there's gonna be a big uptick in trucking bankruptcies. That's already begun upticking. And then last point that he made is that they're not seeing the effects of this longer term nearshoring trend into Mexico yet so much. But, quote, movement from China to other Asian countries has been more significant than that from somewhere to Mexico, but it is trending towards Mexico. So that's advantageous for anyone who has maybe provisions logistics in Mexico or Texas or kind of in that area, as you see more freight flows coming as that nearshoring trend does continue over the coming years, and less maybe of the freight mix flowing into Southern California ports. So just some thoughts on freight. I don't know if anyone else follows the freight markets closely or has any thoughts on freight markets, but I did want to talk about that one. One other thing Hunt called out was that the spot market appears to be leveling out as many carriers are operating at a loss and can't absorb further declines in spot rates. And their president, Shelley Simpson, said, quote, typically that can't last for a long period of time. So you're probably going to see over the next few months here continued capacity rationalization, trucking bankruptcies, et cetera, as these are just not sustainably, these prices are so low, right? It's great if you're a shipper and you're probably happy after how insane your shipping costs were for a lot of 21 and 22, but these cycles happen and they usually go too far in one direction, and it seems like they've probably gone about as far as they can to the downside for spot freight. Hey there, Jiro. Happy Friday.
Hello, how is it going? All good? I hope you can hear me. Because I just wanted to quickly say something. I think Steve, because you were the one who talked about the model of Tesla, right? I think the valuation. Yeah, because I just wanted to mention that a couple of years ago, when I did my master's in finance, I was very interested in that, and I looked at it in detail. And it looked so awesome. They even had a Monte Carlo simulation, as you just said, right? But now, with a couple of years of experience, I know it's utter complete bullshit. Complete bullshit, because they are basically the simulation is, for instance, I think they use the profit margin, right? And then the average or the mean is, let's say, 25% or 30% or something, right? And then if you use a proper standard deviation, then you would actually have the problem that you might even get, not only positive deviations, but even negative margins, right, in the worst case. But what they do is that the standard deviation is so thin and tiny, right, that it's not a real simulation. I mean, it gives you a lot of different outcomes, but actually the standard deviation is so tiny that it's almost as if you don't use a Monte Carlo simulation. And that's why I'm saying it's mathematically complete bullshit. It looks good, but it's total, it has zero value. And that is my feedback to the Tesla model.
Yeah, hey, Carlos. Thanks. You're talking about the Monte Carlo simulation. You're talking about the data mining bias in the Monte Carlo simulation. Is that what you're trying to say?
Yeah. I just wanted to say, I mean, when you look at a valuation model, let's say of a Goldman Sachs analyst, right? Then he would. They all don't use Monte Carlo simulation because they all know it's bullshit, right? I mean, I know you use Monte Carlo simulation, let's say when you're a risk manager and you want to, how do you say, you want to stress test, how do you say it, like your bank portfolio, for instance. But when you do evaluation, then you only have a base case, bull case, and bear case, right? And and that's basically it. And what they do is they just add the Monte Carlo simulation so it looks fancier and cooler and modern and mathematically it looks mathematically sounder, but actually it doesn't add any mathematical value at all. I mean, it just looks nicer to have because instead of instead of three different prices, you have then I don't know because last time I checked, I think they did 10,000 Monte Carlo simulations. But like I said, it is completely bullshit because when you, let's say you have the gross profit margin, with 20%, then you have to have a super tiny standard deviation and you have to cut the whole distribution in order to not have in order to not have a value of minus 5%, for instance, right? Which would be ridiculous. So, and that's why I'm saying, trust me, the value is so useless. And if, let's say, the analyst went to Goldman, JP Morgan, Morgan Stanley, they would be fired in a heartbeat. It is a terrible model.
No wonder why they're not in Goldman, huh? Well, I agree with you. There's a lot of data data bias in the Monte Carlo. It's definitely a flaw. I mean, it's not universal too. However, I'd like to hear is there any takeaway from you if you look at the actual assumption, like the gross margin assumption? For example, their bottom line, like how they drive to the bottom line. Have you take a look at it? Besides the actual price target.
The problem is I looked at it a couple of years ago, right? So that's not actual anymore, and it was before the stock split. But what I noticed was also that the bear case is actually a fantasy case. Because usually what analysts do is when you have a bear case, then you really think about a scenario like what could go wrong, basically, right? And what could go wrong always has to be a price that is below today's price. But what they do is that the bear case is also much higher than the current price, right? So it is ridiculous. It doesn't make any intellectual sense, as Rod said before. It doesn't make any intellectual sense what they are doing.
Yeah, I know. In a traditional DCF, there's always a downside model, worst case scenario. They just like, hey, they're just like, if we shoot for the moon, at least we can get to the sky.
I love too. I'm looking, the valuation assumptions in their downside case are that the EV to EBITDA of the electric vehicle business would be 13 times, which again, you're talking about a car manufacturing business and you're giving it a higher multiple than any other scaled car manufacturing business. I don't offhand know how high Ferrari's is, which I guess it's not like a 1-for-1, but that's probably a best in class. So okay, Ferrari does have a 21 times EV to EBITDA, but I don't think we should be using I think it gets back to Jiro's point. Their downside scenarios are actually pretty freaking bullish to me. So it's just not it just doesn't seem like it seems like the analysis is more intentioned around bringing eyeballs to ARK Invest and bringing dollars to ARK Invest products as opposed to truly seeking truth, which I'm sure the analysts would push back on that, but when you hear Kathy talking about $1 million Bitcoin and Tesla 4,000, whatever, I tend to think it's a marketing exercise rather than an intellectual one. So anyway, I don't know if anyone wanted to talk or had any thoughts on freight, but it does kind of feel like it's near a bottom just based on the fact that spot rates going any lower, you're really going to see probably a market uptick in bankruptcies if that happens and a washout. But okay, the last thing then, if no talk on that, before we can just open it up to whatever people want to talk about, was just the continuation of this trend with rents. So rents now on a year-over-year basis have fallen for the first time since the pandemic started. So the median asking rent fell by a bit less than 0.5% year over year. It's been several months now that I know we've talked about the month over month had already inflected negatively in many markets. And it's just, a continuation of a lot of these dissipating like demand, I guess, impacts on inflationary expectations. You've got refining cracks were down meaningfully over the last week. They were down like more than 10%. So, the market is seemingly pricing in more recessionary risk, even though you've got, a decent purchasing managers composite that came out today, which showed the from the U.S. side at least the strongest PMI out of S&P Global at least since last year. So those numbers are all expansionary again, which is good. So it's kind of a hodgepodge of noise on like the inflationary front, where you've got some demand hanging in there. Definitely got some recessionary murmurings, especially when I look at how much refiners took it on the chin the last couple of weeks. Like that smells like recessionary canary in the coal mine. The Tesla high ticket items, dropping off another kind of canary in the coal mine. So the economy's still chugging along. Unemployment, initial claims are trending up, but still muted. So we'll see. The Fed is priced as a 85% chance that they will hike. I still think they should pause, actually, although I understand it seems much more likely they'll just do the 25 and say that they'll be data dependent going forward. But I don't know if anyone has any thoughts macroeconomically on kind of an inflation front or other, or on anything. I don't have any more prepared content, so we can just kind of talk about whatever people want to talk about. It's 5:06. Probably wrap this sometime by at latest 6 o'clock, so people can enjoy their weekend. But happy to hear if there's anything we missed, any major news or any considerations you guys want to call out. I think while I add Monative, I think one good line from Pantheon Macro's chief economist was, quote, "We have no idea yet how severe the credit crunch is going to be in the U.S. with regard to small business confidence deterioration and how much credit this credit tightening cycle goes after the bank issues last month." So, Monative, happy Friday.
Happy Friday, Rod. How are things?
Pretty good. Hope everything's well on your side of the country.
Yeah. Beautiful weather. Can't complain. Blue skies. So, couple of quick things. So, on your transportation, Night Swift also came out. Hold on, I'll go in 5 minutes. There's some noise here.
Okay. Yeah, Night Swift had earnings, so let me pull that up while you're kind of muted.
I was going to quickly say they do expect improvement in the second half, but they did miss, and it's not really an upbeat report.
Yeah. So kind of in line with Hunt, I think then that it's I guess not everybody's reported it. I remember last quarter though, there was a lot of sense, and the sense that I thought I saw from Hunt's report, which I haven't looked at Night Swift's yet, frankly, was that they just don't have a lot of clarity from their shipper customers around what kind of restocking demand they expect to see as the second half kind of comes up, and they have less visibility than normal broadly. I don't know if you saw anything different. I know you've got noise in the background.
No, where I was actually going with this was, right, again, the performance is starting to get very nuanced, right? If trucking is not doing great, it's clear that they are in some sort of finding a bottom process where the rates are going to bottom somewhere soon, and they're going to there's going to be probably some shakeout of uneconomical companies and consolidation. But airlines are nowhere near as bad as truckers, and logistics companies like XPO are getting some bump ups in price targets. I think it's again, right, it goes back to our other discussions in different places. It's like stock picking is important, but also within a larger subsector, industries are separating dramatically in their performance, and you've got to be careful looking at a sector ETF and making conclusions is not the best place here. Actually, it might draw you to the wrong conclusion, because the performance is really in one small part of the subsector or sector, and maybe in one industry to the opposite of other industries in the sector. And if that is not a large component of the sector, the sector might actually be giving you the wrong sign, while there's actually outperformance somewhere.
Very valid points. You're right. People definitely need to, you've got to dig beneath the surface rather than just looking at maybe a sector ETF to tell the story. Speaking of Knight-Swift in particular, I actually didn't realize they'd started doing earnings calls, because for the years I was at Ryder, they didn't really host earnings calls. It looks like they started up about a year ago. So I do see that they anticipate a somewhat deeper pressure on revenue per mile, and that they think the inflection is a little later in the year than they'd anticipated. So yeah, softness will persist the first half of 23 based on indications from shippers working through their inventory overhang. We estimate that average spot rates have fallen below operating costs for a large portion of the industry's carrier base. That really is the point that I was trying to get at with what I was talking about with Hunt and from Craig Fuller, is that you've got an industry that is like, it's perfectly competitive. There's no real barrier to entry. If I wanted to go out and buy a tractor, assuming I have my commercial driver's license, and become an incremental provider of supply for the industry, drivers can come in and leave, and you're going to see a big outflow probably as people get washed out, right? If you're operating, if the revenue that you take in is less than your operating costs, right? Every incremental mile that you drive, you're losing more money. So even though you're losing money by not driving, we're going to get at that point where I think capacity starts to rationalize pretty quickly.
So the question is, did that actually happen? Did we get a lot of new entrants into the industry?
We did. There was a huge inflow motive in 2020 when we got kind of really late 2020 throughout 21. There was a massive uptick in FMCSA carrier authorizations, as you got a lot of folks looking to chase what was an extraordinarily hot freight market.
I remember ships were stacked up outside the channel at Long Beach, and the wait time was months.
Yep, and there are none parked outside Long Beach today, right?
Yep, yeah, exactly. So that excess capacity that came in because of the demand pull forward needs to back out and needs to shake out and go back to maybe a 2019 normalcy or something like that.
So I pulled up on my screen, this data is from FMCSA, Federal Motor Carrier Safety Administration, one of those two, and it shows really in 2020 you saw, just especially in the third quarter, just huge upticks throughout 3Q20 until the end really of 21. Just a huge uptick in for-hire carriers being added. So pre-COVID, granted 2019 was a freight recession, but 2018, 2019, we're talking about 15, 16,000 per quarter. The average in 2021 was 48,000. So 3 times the pre-COVID level of incremental carriers being added. And, that that just shows you that supply was added. It's going to have to come out. It's starting to come out, but there's probably more pain, at least in the very short term, in that space.
Yeah, it's already been an interesting earnings season so far, right? There are maybe 100 companies in S&P have reported so far, and it's wildly different within a larger industry group. Things are so. I mean, look at the performance of Lam Research versus say somebody like I don't know. TSM or even ASML, right? Both of them did fall after earnings. I think they recovered, but Lam just took off, and it's so counterintuitive because Lam is the biggest supplier to the DRAM industry, and you saw the results from Micron and Samsung have just been horrid, right? They're cutting back fast. They're taking capacity offline. They are cutting costs on DRAM. They're dumping excess inventory. Reducing shifts. All of these while the supplier is just blowing it out of the water and the stock is running. So it's I think the signals are really messed up right now. I don't think you can make any broad stroke directional calls based on what we are seeing, and I think we're going to have this difficulty. Same thing even in financials is happening, right? The good and the bad are separating pretty fast, and the performance after earnings release is pretty stark. So I think this, people have to put in a lot of work. It's not obvious who the winners and losers are going to be after this earnings season. You better dig in much deeper and do some work to get that alpha.
What are you looking? Are you expecting from the mega caps that start to report next week, Monative? Your point about hardware, like from Samsung, and obviously there was the Apple Mac, really big fall off in 1Q. Do you think, because I know last quarter Microsoft talked about how bad hardware was, and you'd have to think it's going to be a continuation of that. And obviously there's a whole lot of different stuff that Microsoft is involved with and that people can talk about at Microsoft. But I think Microsoft will be helpful, at least, to inform like where the different aspects of all the stuff they touch is performing.
So okay, interesting, right? Let's talk about that for a minute here. So Mike, if you go back to Netflix's earnings, again, Netflix is not the greatest example. Actually, it's a pretty horrible example of hedging your currency risks, but they do it in a funky way. But set that aside for a second. There was continued strengthening of the dollar for most of Q1. So there is significant currency risk, possibly worse than Q4. So if the example of Netflix is extrapolated, and certainly all of the mega caps have far more exposure to as a percentage to currency translation risks than even Netflix does. So I think that's one risk I would be looking at, from their earnings misses that are because of currency translation. Now the street might look at that and say, yeah, it's a one-time thing, or it's a really not a performance issue, and might discount that. We have to see. But going back, if you go back last quarter, I think what spooked Amazon and Microsoft what spooked Amazon last time was the slowdown in AWS growth projections. So AWS for Amazon and Azure for Microsoft are primary growth drivers. So if Microsoft has any slowdown in cloud, that could be a pretty large deal versus, for example, GCP is a tiny part of Google's actual revenues. So any significant slowdown in cloud is going to impact, and of course it's nothing at all for Apple, so it doesn't matter, would negatively impact Microsoft and Amazon a lot more. And then when you start digging in further, right? So Microsoft, my biggest problem with Microsoft is 140 odd billion in cash on the balance sheet, and they are going to close a $70 billion deal this year. 70 billion all cash. That is what, 68, okay, 68.
Yeah, I know you're not a fan of the Activision deal at that price.
So those are things I actually don't see a super positive for Microsoft, and AI is not actually going to generate any revenue for a few years. It's hype, and it's bringing in potential, revenue into Bing, but that doesn't move the needle, right? Even getting an extra $5 billion of revenue from Bing is not going to move the needle for Microsoft. What will move the needle is a slowdown in Azure is going to, really hurt bad. So I think, again, right,
and that's a good point, because investors look at cloud growth for Microsoft as one of the big kind of items. So you're right, if that cloud growth is disappointing, that will probably override some of the other
and
stuff.
weirdly enough, right, what they are doing is sleight of hand, right? Financial engineering. They are going to move $10 billion from cash to cloud revenue, which is basically credits that they have given to AI for a stake, right? So they're going to create this a journal entry for an ownership stake, while all it really is basically keeping OpenAI from not using any other cloud service, right? So it's protecting Azure revenue is what they have bought, nothing else for now. That benefit from that investment is going to come, down the road 2-3 years, right? All that happens now is just the the wins in, let's say, social performance rather than financial performance. So it's more what is,
and it's trading at 30 times forward
exactly
earnings,
it is
so
the most expensive.
you need a lot of growth.
Yeah, so I think people are not scoring that. That could be the biggest downside risk, could be Microsoft. I mean, look, Apple, it's already the bad news is out there. What bad news is out there for Microsoft? None. They're priced for perfection.
And last quarter wasn't great for the mega caps, and they all kind of just survived it. So I wonder, do we start to get any more? Because a lot of the, like, what's priced into analyst estimates and the outlook is a very strong second half, right? Like, a lot of companies have said, oh, we're gonna make up for it in the second half of the year. And I don't know if it's this quarter then, or if we wait until 2Q that people start to maybe revise downward some of those expectations. It just still seems like there's a lot of hope and optimism priced in, especially when it's like, okay, you're at 30 times 2023 earnings for Microsoft. Now Apple is a little bit less rich. I think it's 27. Yeah, 27 times, which Apple's just not growing as much as that sort of a multiple would imply. So I don't know. I'm pretty surprised by the big cap resilience through this quarter. So we'll see if when they report, this is kind of finally the thing that maybe knocks some of them off the perch after this rally here.
Yeah. I think. Well, I don't expect it to be horribly bad, right? Because these guys, do have sticky customers and revenues that don't fall off fast. They do. The growth slowdown is probably the story more than an actual revenue decline. Apple's case is a little bit different for Mac. That's a that's a fast swing. 40% is going to bite, but again, thankfully Mac is not that big from the larger picture. But there's definitely more interesting prospects if you go down to, let's say, the 500 billion to 200 billion market cap tech. There's probably better upside surprise prospects there than you would in the ultra mega caps, trillion or close to trillion and more.
Let me ask you, Manadev, I don't know if you have any thoughts on Zoom. I had seen that they had broken down and they were trading at what looked like at least a 1-year low, ZM. Uh, and they actually don't look that expensive. And it's funny because I'm not a Kathy Wood fan, but they actually look a little like almost like a value type play at the levels I'm seeing. Like the EPS, they're trading at 15 times 24, which I guess is their current fiscal year. We're talking about low teens EPS multiples out a year or two. So I don't know. That's one that I had seen, and it's obviously just completely out of left field. But is that one that you follow at all, or
a little bit. I mostly follow Razor on Zoom because he spends a lot of time digging into that on a regular basis. I again, right, that's the size I like, right? Sub, let's say 500 billion, there's going to be lots of upside surprise. I think just what I'm seeing here is the there isn't, right, I mean, take it how you will, but there isn't a desperation to cut staff as much among the Adobes and the Autodesks of the world as there is among the Metas and the and the Googles and the Amazons of the world. So that tells me that they are able to sustain the the staff and for whatever reason that they've not it's not that they can't, right? There's plenty of companies that have cut back dramatically, so it tells me that there's something going on there, that they might not lose momentum that much or as badly as could be expected from a slowing economy. Again, right, you have to really look at parts of cloud, parts of cybersecurity that are stickier in terms of budgets, and I think those are where you're going to see outperformance in the next year, for, let's say, 4 or 5 quarters before things turn back around for the rest of them. So I still have to do a lot of work, but that's honestly my take is not the 4 companies that everybody's piling on to, but the or even, I mean, just look at just look at not that it's cheap by any stretch, right? It's not, it's very expensive, but CRM, right, it's been sticky. The price is not budged at all. It's holding between that 195 and 200 for a while now, since they're since really since or let's even say 185 to 200 since the last earnings, and it's been holding that very well even on red days, right? Okay, we've not had seriously red days. It's like 100 points here, then gain it all back in a few days. But that's what I'm going to be looking at, right? I need to spend some time. Saturdays are my research days, but need to start pulling up a list of somewhere between, let's say, 100 billion, 500 billion companies, and see what their exposure are to a pullback.
Good stuff, Manadev. Appreciate it. It's 5:30. I think we'll go about another half hour. I hope anyone who's listening, if you want to chime in with any thoughts on earnings season to date or any of the topics that we discussed earlier, you're welcome to. We've gone through all of the kind of prepared content that I had. So if anyone wants to ask any questions or chime in with any of their thoughts or perspectives, we would welcome you up. I'm not going to force you to come up and speak, even though I see some people listening who I'd be happy to have come up. Manav, I always get worried when I look at a technology company and I see it, I look at Zoom and it's like, wow, it's got like a 9% EV yield right now. Anytime a value type guy is thinking of buying a growth type stock, it's just a red flag. I just need to stop doing it. Don't even look at it any further.
Well, you never know. I mean, look, it might really be a play that's been grossly overlooked, right? I mean, honestly, the market has become so narrow in valuing just maybe the top five plus another dozen others for whatever reason, right? Let's say the Palo Alto networks of the world. That's all are getting a premium now. The rest are either being ignored or sold off. So it could very well be that the market has gone way overdone this, and there is value there, which is why I said, right, the interesting
Well, I think
mix is always going to be in the smaller ones.
Oh, for sure. And I know I'd mentioned it at some point that the Qs to the IWM, I don't know if it's the Qs to the IWM or which specific ratio it is, but that's gotten to like .com level extremes in terms of the ratio of kind of the technology oriented companies to the small caps. So the spread in value, if you're trying to dig for value, I would agree with the sense that it's hard to find value in these mega caps. Maybe you can find more value in stuff that's still a big cap that's not in that rarefied air of the the $1 trillion or many $100 billion companies. But even more so than that, it really highlights that the fear of recession is really weighing on the small caps. And if you feel like you can identify a small or mid cap that has maybe some impressive sustainable competitive advantages, pricing power, yada yada, whatever your weapon of choice is, then that might be a better place to look for forward returns, given there's such a disparity between the valuation the market's currently placing on these bigger technology companies and the smaller companies. Don't know if anyone has any thoughts or pushback on that notion, but would be happy to hear it.
Can I chime in with something?
Please.
Okay. Just about earnings. So first of all, so I can just give an analogy here. It's about we're looking at, so we're talking about mountains and snakes. So for example, you're sitting in your backyard and then you're looking at this beautiful mountain like miles away down the line. And then there's a snake in front of you start picking at you. Like, what would you worry about? What would you look at first? The reason I'm giving this analogy is that I've heard so much sales analysts coming out these days, especially during earnings season, say, or even CEOs, oh, this is just a temporary bump. The worst is over. You have to look forward. We're looking at 2024 EPS. We're looking at 2025 EPS. Things going to get better. That's the mountain you're looking at. So you have to so we're talking about a narrative or psychology-driven environment where some point down the line, you have to think about the probability of investors start worrying about the snake that's popping in front of you. So it's like they can't ignore the snake anymore and they start panicking about snake. At this point that nobody's really panicking, I'll say they're just looking at, oh, the mountain's beautiful, everything's gonna be fine. And then, we're just gonna, everything's just gonna be okay from here. And I'm giving this this analogy because that, right now, there's a lag between how the monetary tightening cycle is gonna contribute to corporate earnings. And then the time lag, I mean, you can backtest it. The lag is it's not immediate. It takes time. And then if you say the SVB bank run is a result of the lag, I would say that's kind of premature. That's nothing. So I would say that, if you're looking historically, we just had one of the biggest, well, we've had the fastest rate hiking cycle in the history. And then, I mean, if that's all you get, I mean, you have to question if the mechanism, the physical and monetary mechanism is still working or not. So, yeah, I mean, yes, people are worrying about it right now. With these type of earnings coming out, it's still the delta is still very small. I mean, so straight looking at what we're looking at, 2020 earnings, 2024 earnings. People are looking at 250-ish. So that's like 12% year over year. Okay, I would say very ambitious. Maybe a little too optimistic, I would say. But I think sooner or later, people is gonna concerning. What about what's the snake is in my backyard? Should I be worried about that? And I think that's when people start panicking about snake, and that's as a long-term investor, that's when you start looking at, okay, now's the time for me to looking at the mountains, because everybody's looking at snake now. Just that.
So it's a rabbit hole I shouldn't really go to, but I'll keep it very short, and I'm gonna actually stop, let others talk. But look, we've had this bugaboo about the recession is coming, for a freaking long time. We've been talking about recession while the unemployment rate's been going down. It's barely budged up, and we're still talking recession. It's coming. Yeah, of course, someday they'll all be right, and we'll have a recession. But until then, we're still at 3.5%. If you take last month's unemployment report, there is no possibility of a recession at 3.5% unemployment. That is just downright silly to think that a recession is around the corner and we are at 3.5% employment. Is it possible that the rate crashes so badly that it's never happened, outside of the the COVID shutdown? Yeah, it's possible theoretically that we could suddenly jump to 4 in one reading, and the panic, and the customers could dramatically pull back, and we could finally get the recession. But the likelihood of that is pretty darn small right now. It looks like the recession is coming based on Fed data only in 24, and according to the Fed, it's still going to be a shallow recession. Whether you believe them or not, that's up to each person to make up their mind. The second part is this notion of S&P earnings. Again, it's a number, it's a marker, it's useful after the fact. You're never, putting together 500 companies into one bucket, 500 companies that are as different as you can possibly think of in their economic cycle, in their market cycle, in their phase of growth, in their risk profile, customer profile, geographical exposure, interest rate exposure, any way you think of it, this one combined number, I don't know why the market is so hung up on this number. There will always be sectors that slow down dramatically when things are slowing down faster than the rate of slowdown. Obviously, we are seeing that in tech with the decelerations. Same with consumer discretionary and the risk on sectors like that, communications, right? But there will also be sectors where there's barely any slowdown, right? Look at the outperformance of utilities. They are at their all-time high multiples, and they're still going up. There's still money coming into the sector. So I think it matters very little other than after the fact and say, oh, you know what, back then there was a recession and the S&P's earnings pulled back to this number. When it is happening, I think to me, it has very little relevance. I don't invest in the market as a whole based on its earnings. If I invest in the market as a whole, it's basically only to, to de-risk and diversify my chances of pullback, right? If not, if I'm looking for the upside, I'm investing, in a sector where the sector macros are lined up correctly to the economic cycle.
I mean, Monative, I agree with what you're going at. I bring it up because it is, the S&P is the best, or is a good proxy for, the large caps in the market and what people think about them. So you're right. No, unless you're investing in the index, you don't care all that much. And if you're investing in the index, you're probably not caring about single names too much anyway. But you're right. You don't have to buy the index. You're buying single names within sectors that you've discerned have some, compelling, whether it's a valuation reason, whether it's a sustainable advantage they have. But yeah, are there, your point though is that about like utilities, that's a good one. I mean, it's a flight to safety type sector. Really, after the bank kind of issues arose, utilities are up almost 10% since those issues started happening in March. Which they're not quite at the highs. They're obviously down still from the highs that they saw, but and the valuations are, in the context of how high, to Steve's point, how quickly risk-free rates rose. I guess what I'm trying to say is that a lot of these companies, when you look at how much cash they're generating and what you could yield just sitting in risk-free bonds, some of the math just, it seems like people are in equities, and it's like, why are you in some of these equities? And it's probably less about a unique reason why they've selected a stock and maybe more about just flows of assets. I know that I'm sure a lot of people have seen how much liquidity returned to the market year to date, and I'm sure everyone's seen their favorite charts of liquidity overlaid with whatever index they prefer and how much of a correlation liquidity's had rather than maybe more fundamental reasons. But it does still feel like it's a liquidity driven market, and to Steve's analogy, people are not as concerned about maybe there being more and more snakes popping up in the bushes near them than they should be. And the opportune time to buy is when everyone's only concerned about the snakes and not looking at the future. And broadly, I don't think we're there, but I would agree with your sentiment that if you're buying single names, then it doesn't really matter as much where things are broadly, although it's worth taking a pulse of.
Yeah, I mean, sure, right? It's always going to be important, but like I said, for me, that's something I look at after the fact, right? Okay, what is the level of outperformance in a sector that is sensible in the context of the overall market, rather than the overall market is doing this, my sector needs to do this, right? That reverse doesn't work.
Yeah, I mean, we don't need to go to rabbit hole here. I mean, I respect your process, and if the process is working, that's just great. Do you guys want to talk about China? I mean, there's always alpha to generate. Like, it doesn't have to be United States. Chinese GDP just grow like what 4.5% is, and then there's a lot of people are talking about new credit cycle. What do you guys think?
Yeah, it's a good point. I think the U.S. is toward the end of this long expansionary cycle, if we exclude kind of the blip, and then China is clearly at a very different stage in the cycle, having kind of flipped the switch back on. You're right. The first quarter GDP up 4.5. The IMF estimate for the year is that it'll be 5.2 growth for the full year. Good for Chinese trading partners and for energy in the area, and for tourism, now that people can actually do that again. Yeah, the IMF had said that they believe China is going to contribute about a third of the world's growth this year. So China being kind of at that return to growth earlier stage in the cycle, I think that's some of the upside scenarios, is if the Chinese stimulate, have some more stimulation in their economy, can that help, drag the world up if the U.S. continues to slow? Like Monative said, it doesn't seem like we're going to fall into some deep recession imminently. And if you have a deceleration in growth or negative, modestly negative growth, it's not the end of the world if that happens in the U.S. For some period of time. It's part of the, just that's the way the world works. Steve, did you have in China in particular any thoughts on kind of what you're seeing?
Oh, you asking me or you asking somebody?
Yeah, you.
Oh, well, I was just open to you guys. I was just looking at some economic data, but that's nothing too specific.
Jeffrey here invests in China. He's been pretty bullish on it. But yesterday, Nomura and Bank of America bumped up their GDP estimates. Nomura is at 5.9 already, so it's going up. The estimates are going up for the back half of the year, and full year estimates are also bumping up fast. So whether I'm not seeing the numbers outside of China's internal spend. So this is this is the thing, right? So the dry bulk is flattish to slightly off the bottom. Ores are up a few days, down a few days. It's not sustained offtake from either South America or South Africa or Australia. So the larger signs of a sustained upside I don't see yet. If it's happening, it's slow, but internal consumption in China seems to be pretty good, and you can see that also from the LVMH of the world just killing it.
Yeah, and also I think the LVS Las Vegas Sand report this week also shows strength in consumer spending as well. The casino operator.
Yeah, right on. All of them ran. All the Macau casinos ran. You're right.
Yeah, I got a couple questions. Maybe one of you guys can answer it about China. Do you think that growth is coming from a low base, and when is this going to show in the commodity prices? Because even in the commodity futures, it's not really showing whatever GDP they have reflected in the commodity futures.
That's what I just mentioned. Last on. I've not seen that either. So that's why I said it could be a return of consumption, but not yet return of production, right? Industrial production. That's at least what I'm trying to make sense of here, right? I don't see the ores, offtake picking up. I don't see large orders being placed. Coal is picking up. So, maybe they are getting ready to restart industrial activity, or it's possible that they still have a large stockpile of ores that they're using up. I don't know that level of detail, but you should see iron ore firm up. You should see copper firm up if China's really cranking out the manufactured goods, industrial goods, and I don't see that quite yet. It's bottoming, but it's the upside. I'm surprised. I thought by now we should have seen some perk up in primary metals demand from China, but not yet.
So one thing I read was that like China's loan demand basically like is almost as high as when it was when they tried to stimulate it 2008, and they're hoping that helps the housing market like start up again. Because without the housing market, I don't think the only thing you're going to get is probably like consumer spending on consumption they're trying to make up when they're locked down. But they're an export driven country, and of demand for China goods are going down. I don't see how they're gonna drive growth like globally.
I'm far away from a China expert, but it stands to reason that there are millions of unsold apartments. So even if loan demand is picking up, activity is not going to pick up for a long time until all those buildings are absorbed, right? They overbuilt by multiples. So yeah, I'm just guessing here, right? It's not going to show up in industrial activity, construction or consumption of materials for a while before they actually have a need to start building. Heck, they were taking down unused buildings by dozens just a couple of quarters ago. So I think we're some ways off before that happens.
Hey, Jeffrey, you want to chime in?
Just from what I've been kind of looking at is China's credit impulse is kind of trending up. It's kind of it's moving up. As far as the China home values, they're also trending up. They've stopped going down and they're trending up. I do know there's talk about a $1.8 trillion infrastructure spending bill. Also, they know what they need to do. They need the consumer to stimulate the economy. So they're looking at all kinds of things as far as creating a consumer to spend more. I'm sorry, I'm driving, so it's kind of like.
And aren't Chinese consumers' balance sheets pretty solid, Jeffrey?
Yeah, there's $3 to $5 trillion more in their bank accounts than there was pre-COVID, right? So from everything that I've read, so yeah, they've got money to spend. It's just getting them to spend it, and I know they're doing not coupons, but vouchers and all kinds of stuff to get them to spend. And if you think about it, they're a what is that? Trying to think off the top of my head while I'm driving. If I get more, I'll come back up. I apologize. But yeah,
like I read where that Chinese consumers are hesitant to spend because they don't have like a lot of the safety nets we do, like 401k, retirement plans, healthcare, and all that. So they're more inclined to save. They're more inclined to save instead of spend because of that. So unless the government like changes that around or have more policy that support those kind of programs, like no matter how much they save, they're not going to be inclined to spend.
So, I mean, one of the biggest contribution for the GDP is, I mean, one of the retail sales. But you have to concern the delta you have, because if you look at 2020, the retail sales was minus 0.2, right? So that's the biggest delta. It's kind of a mean reversion, more of a, you're talking about growth assumption. So we have to consider, is that really a growth driven story, or is it just a temporary mean reversion rebound? And yes, industrial production is flat, and then there's not much delta in terms like 2020. Well, 2022 was 33.6. So prior to 21, it was more like a mid-single digits. So that's something you have to require to have a more sustainable growth in their GDP.
right. Well, it's 5 to 6. So, Jeffrey, go ahead.
Yeah, so I actually added to the nest the Q1 GDP. Manufactured up 2.8%. Excuse me while I'm driving. Construction's up 6.7%. Wholesale retail sales up 5.5%. Hotel catering 13%. Finance is up. Real estate is up 1.3%. IT spending is up 11.22%. It's in the nest. I'll add some other stuff if you guys are still on. Like again, I apologize. I've been driving, but they're going to push the consumer. They're going to push the consumer to spend. They know that they're going to subsidize the consumer to spend. This is a social credit system where they can literally force people to spend. They can give them money and then force them to spend it, right? So who knows how this is going to go. I do think China is trending up. They just had their best month for exports. So and now it wasn't to the U.S. It was to mostly Asia and other countries. Probably Russia's in there.
But like I know investors are hoping, and I am too, because I'm kind of long on some Chinese stocks, that the government does do fiscal stimulus. But so far they've been hesitant to do that. They're trying to still do big infrastructure spending and all that. So hopefully they do that. And I think if they do that, then I think it might contribute to growth in the near future.
Yeah, I think when you heard the Fed stop tightening, that's probably when the Chinese PBOC will start printing.
The other Steven that just came up, you're welcome to chime in.
Just I just said, I was thinking about, when's the last time you've seen an interstate fixed? Any of the interstates? I mean, repaved, potholes. I mean, I drive from the Bay Area to Santa Cruz on the 5, and you're gonna need a whole new front end by the time you get back. Down from Bay Area to LA and then back. But they all say infrastructure, but they never put the money in infrastructure. It's pretty interesting. And then
we had real rains for the first time, right? So.
Say that again.
I said we had rains for the first time in what, a decade now?
I mean, the rains like we had, it's been 20 years like that.
Yeah, it's like a highway of potholes with roads.
The roads are trash, bro. But and also for oil crude, they're talking about filling the strategic reserve back up by the third quarter if the price is right. Scroll all the way to the left. That's where they're hoping to get this oil to. $40-$50.
Hey, does anybody have any idea how Amazon earnings are going to be? Because retail sales is pretty. Well, retail sales were up this quarter, and one of the biggest contributors was online sales. So does anybody got any input on that or any guesses?
Are they laying off some more people to help with their margins?
I don't want to overstay Raj's welcome here. He wanted to close it in 2 minutes. But we talked about this, right? So Amazon moves on AWS. So it might not matter what the retail sales do. It might help the numbers, but if the growth rate of AWS is not stabilized, last time it was low, and that's what killed them. So if the growth rate doesn't stabilize or improve, I don't think anything in retail can help them.
Yeah, so I'll just add, you'll get Microsoft first. So whatever you see out of Azure, you could probably get a little bit of a read through, and I'm sure Amazon will react. And at least on the kind of mix between retail sales in terms of brick and mortar to non-store, the last few months, there's been a bit of a resurgence where you're seeing brick and mortar lagging again markedly and non-store growth ticking up and beginning to take share again. So kind of a return to the pre-COVID trend. We've had a little bit of a period there in in 22 where brick and mortar was doing fantastic relative to not to e-com, but I think that e-com resurgence relative to brick and mortar will be interesting to see, I guess, what we get out of Amazon on that, and how their share is holding up. But I would agree with Monative that cloud is probably more important near term. What the trends they're seeing in cloud are that they talk about in 6 days. So it is 6, and I appreciate folks wanting to chat. We've been going for about 2 hours, so I am going to start my weekend and shut the spaces down. And did want to thank everybody who came up and spoke. We do this 4 o'clock every Friday, so you're welcome to tune into our Wook and Review calls. We have some prepared content. We talk through the prepared kind of sector and company topics, and we kind of open it up. We also have on Wednesday nights an open mic where we talk about whatever people want to talk about. I post that on my personal account. So at 7 p.m. Eastern, we've been doing that for several months now. And they sometimes we have dozens, sometimes we have hundreds. So sometimes it's a pretty intimate group. Other times we get a big group. But they've been going well. And then this coming Tuesday, we do have our book club. So The Big Short. I have actually not finished the book yet. I've only seen the movie once, but we're going to be talking about The Big Short, which I thought was fitting on the back of the bank crisis. So that'll be 8 o'clock Tuesday night on the Wook handle. We'll be hosting that book club discussion. So be sure to follow the @Wook Capital handle, and you can also follow my personal handle @Rod Alsman if you want to tune into any of our broadcasts. Thanks again, everybody, for your interest in Wook Capital Management and our programming. And we look forward to talking to you again soon. Have a great weekend, everybody.